Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome to the podcast. Thank you very much for being here and for tuning in. Today, we are going to talk about part 2 of equipment financing. So if you have not listened to part 1 of this, please go back, listen to the previous podcast, and you will hear part 1 of equipment financing. We are going over the chapter in Nelson's Becoming Your Own Banker book, and we are reviewing that. So we're just going to continue on with that. And before I do that, guys, if you want to share this, that would be so awesome of you. I would very much appreciate it. Just like if you would share the book. That's always nice too. I understand if you don't. People think you're crazy. All right, let's get on to the second part of this. So I was just talking about in chapter 1, why you want to be the banker, why you need to be in the business of banking, the power you have in the life insurance company. And now when we get further into this chapter, Nelson starts actually going over numbers, and he's got some case studies, as I will call them, as well in his book. And he's going over numbers. And this is where it starts to get a little bit hairy when people look at these things. And so you are most likely going to hear me say, this was done for illustrations purposes, because a lot of what Nelson did here was for illustration purposes. And we need to think outside the box. Remember, he said, this is a practice in imagination, reason, and logic. And you must use all 3 of those things: imagination, reason, and logic. And so he starts talking about financing one semi. Because his nephew was a logger, he starts talking about financing one semi. And we are going to finance it through the policy of which we first capitalized, right? We put the money in there for 4 years, and now we are going to start borrowing against that policy to buy a semi. And we are going to pay ourselves back at the same rate that the lease company was charging us. And he has an example in this chapter of a lease. And so if you are leasing equipment, then great, you can go down to the equipment dealership, have them drop a lease for you. And if you bought the piece of equipment, then pay that same lease payment. And that's what Nelson was paying back to the policy. Now, he saw that when he gets in here, he says that, oh, this was absolutely fantastic. So why wouldn't I add a second truck? Because I am a trucker in this example, and I have a fleet of logging trucks. So why wouldn't I add a second one? And if I add a second one, that makes me more money. But now Nelson says, remember, the wisest thing you can do is to add additional policies to your banking system to enhance the ability to finance his entire inventory. Well, he can't just have one policy. He's going to have a system of policies, because if we're paying ourselves back more, like I said in the last podcast, anything extra, can't always fit in the policy due to that taxation of the MEC. So if we're going to cross that MEC line, the modified endowment contract, if we're going to hit that, then we need to make sure that we just start another policy. We're going to have a system of policies. But by him financing a couple of his trucks, he had an additional $2 million of added value. That was not from interest and dividends. That was from him paying himself just like he was going to pay the lease company. And he said, another improvement can be achieved by backdating the policy for 6 months. I get this question a lot. Well, Nelson said to backdate the policy 6 months. Okay, I have not heard of a company that will backdate a policy 6 months just to backdate a policy 6 months. Your birthday has had to be 6 months ago in order for us to backdate a policy 6 months because we are backdating it to save age. So not always does that work. But why does Nelson say backdate a policy 6 months? Because then you can get 2 premium payments in the first 18 months. Now, we can do that without backdating a policy. We can get extra money into the policy and capitalize it quicker without having to backdate it. So if we're doing that, then we can turn around, borrow against that money in 7 to 10 days, 30 days, depending on the company, and start using it. So the point here is if you're paying yourself back, you have to start more policies. And the more policies you have, what? The more money you have. We have to be able to pay that premium. But Nelson had 49 life insurance policies. Why? Because he did what he preached. He paid himself back more. He ran his income through the policies. And I think this is interesting too. He says, wherever a large pool of cash is accumulated, there is always a barrier of some kind to keep most folks out. There is always some other party that has privileged access to that same pool of money. They are the gatekeeper and toll taker. So think about it. The greatest pool of money is in the banking system. You most likely are not the privileged that gets access to it, but then the person holding that money is the one that gets to keep you out and make those decisions. And that is exactly the problem that most people run into. We get kicked out of that system because we're not privileged, or we have to jump through 15,000 hoops to have access to it, which we think is ridiculous, but it's their money. If you had a bunch of money that you were going to lend out and I walked up to you and said, hey, can I borrow some cash? You might ask me a few questions. You're not going to just hand over money. That is why the banks don't just hand over money. So one way to get money into policies is to pay ourselves back at a higher rate, right? Instead of financing 1 truck, he financed 2 and then 3 and then 4. But Nelson also says, comp and collision typically runs 75% of your fully insured premium. So if we finance a truck through a bank, if we finance a car through a bank, anything, we have to have comp and collision on it. They want to have full coverage. Nelson is saying in here, if you finance it yourself, take that comp and collision that you would have paid to the insurance company and put that into a policy and self-insure. Again, you need to capitalize that. You need to make sure that you can self-insure. And if there's a loss before you have all the money for replacement value, that you hope nothing happens. And I get this question a lot too. Well, I just want to self-insure for X, Y, and Z. Okay, great. Just know we're not going to have access to everything we need if something happens. You're going to take a bit of a risk to do that up front. Can I self-insure for crop insurance? You sure can. It's a huge risk. Nobody has quite understood how to mitigate that risk because we just don't know what the weather's going to do. But you sure can. And there are people that do it. They just don't buy crop insurance. And if they have a bad year, they have a bad year. That's how they're self-insuring. They're just not buying anything. But when they don't buy it, they also don't put the money aside for the bad year. So all those guys that have never bought crop insurance, and I've heard there's quite a few of them out there. So I've never bought crop insurance. Am I being honest and actually using that money and putting it in a savings account, putting it in a life insurance policy? And then I have the money if I need it because I had a bad year. If you're going to self-insure, you need to understand the pricing to do that and the cost to do that, which then comes back basically to that, hey, you're going to need to capitalize this thing and take that risk. So as easy as it sounds, make sure that if that's something that you want to do, you're not forgetting that if I have a loss in 3 or 4 years, I'm not going to have the money to actually replace that vehicle. But the bank wants you to have that. And here's the other thing on that note. If you guys are carrying a $500 deductible on your insurance, why? If you have a claim for $600, are you going to turn that in? If you answered no, then I'm going to ask you again, why do you have a $500 deductible? You figure out where that magic number is that you're going to turn that claim in. You're overpaying for insurance if you're not going to file a claim at $500. If you have a $1,000 deductible and you're not going to turn it in at $1,000, why isn't your deductible $1,500? People want to pay for these low claims, but then they don't ever actually turn them in. Why are you giving all that money to the insurance company? If you have a higher deductible, what can that save you in a year? And maybe it's not a lot. I just went back and forth with my insurance company. They wanted to have a $250 deductible on our camper, which is stored inside and didn't even get used in the last year. I said, well, I'd like to do 1,000 or I'd like to do 500. Oh, I'd like to do 1,000 because the 500 between 250 and 500 was basically nilch for savings. I'm like, well, then put that sucker as high as you can put it. What are the odds of that getting damaged? And I will always have enough money. I'm not going to drain my accounts. I'm going to leave enough there if we have something that happens and I'm going to need to use a deductible. I will have enough money. The problem is if you have a high deductible and you don't remember that, and then you don't keep that money in a savings account or in cash value. So when the time comes and there is a loss, you don't have anything for the deductible. So don't get too big for your britches. If you're going to do that and save some money, make sure you have that deductible on hand. In the next part of this chapter, he says the company, a corporation, should not own the policy. He can improve a wealth-building effects of a whole life scenario by owning the policy himself, purchase the trucks himself, and lease the trucks to the corporation, making sure that he has charged a lease payment that is as high as possible. By doing it this way, he can have an interest deduction for the policy loans used to purchase the equipment. So a lot of people say, well, can the farm, which is an LLC, own the policies? The farm can own the policies, but then it is an asset of the farm, and the farm then just lends the money back to the farm. What Nelson is saying is if I own the policy, I can lend money to my farm at 8-10% interest, and the farm can then pay me back. The farm can expense the interest rate, and I have interest income, anything above what the insurance company is charging me personally to borrow that money. Is it better one way or another? For the interest part of it and for taxes, it is better to have the policy that you own personally because then you can lend it to the farm. If the farm is borrowing from the policy, the farm can't charge itself more interest per se, and it wouldn't make sense to do that on taxes. If you don't want that to be a personal asset and you want it to be an asset of the corporation, then you're going to want the corporation to borrow or to own that policy. Now, keep in mind, Nelson was talking about from the interest aspect of it. That is a question that I get a lot. Who owns the policy? If you are in a partnership and the partnership doesn't own the policies, then you own it personally on the other person and vice versa. And I do believe that I have done a podcast on that as well. Towards the end of this chapter, Nelson talks about, he goes back to the numbers and he talks about where did this extra $160,000 of capital come from? And he said it's the interest he's paid into the policy. Extra interest is what he should say here because that would probably clarify things. It's the extra interest he's paid into the policy. Extra interest meaning above what the insurance company charged him. On his side, it was extra interest. On the insurance company's side, it was extra premium. Because if I'm going to charge myself 10% interest, I can't pay anything more than 4.76 to the insurance company because that's what they're charging me today. So anything over what the insurance company charges me has to go into the policy as a premium payment, which increases cash value. If it fits. Again, if it doesn't fit, what do? We start another policy. We're going to have more than one. In the addendum of this chapter, Nelson talks about people saying, yeah, but Nelson, when you wrote this book, interest rates were higher. And I love what he says here. And he says it much nicer, but I'm going to sum it up. Who cares? That's the German matter of fact. Get over it. If interest rates were higher, okay, so interest rates aren't higher. When interest rates go down, then you should expect to have to put in more capital in order to achieve the same results. Yes, the insurance companies were paying higher rates, possibly. They were paying higher dividend rates. And now interest rates are low, and they're not paying that. Well, then if you want the same number, put more capital in, right? Everything is relative. Nelson used to say that all the time. It's all relative. Doesn't matter. It's all relative. And I've had people say that too. Well, email me. Mary Jo, your book is a little bit outdated because the rates aren't the same. Farming isn't the same. Well, no kidding. It's not going to be. Remember this thing called imagination, reason, and logic? Use it. If you want more money, you got to put more money in. Capitalize it. If you're going to capitalize something the way we're structuring them today, the way Nelson was structuring them, cash value didn't grow as fast. The way we're structuring it today, if you need that money quicker, we can get it to you in a faster manner. But you must capitalize. See, I went off on a little tangent there. But now that I'm looking at Nelson's book, he says this is an exercise in imagination, reason, logic, and prophecy. Of course, he said it much nicer. He probably said, this is imagination. This is an exercise in imagination, reason, logic, and prophecy. And I say, get over it and think about it, right? The first time I met Nelson, I asked him a question in the middle of a room. He was doing a presentation and I asked him a question and he said, think about it. I thought, oh my gosh, I just got yelled at in front of everybody, right? But how often are we not actually thinking about any of this? Well, your numbers are off. Well, this number isn't exact. Are you controlling the banking function? Do you have a farm operation and a bank? Because remember the last podcast, that was one of the big things is we need to be the bank. We need to control the banking function of our life. We're the ones that need to have access to that pool of money. We get first dibs to that. Get past the numbers. Get past the fact that we have to capitalize and understand that this is a function of banking that we control 100%, and we don't have to ask anybody for that money. We don't have to ask permission of when to pay it back, how to pay it back. It's ours. He also says this will vary with interest rates and how you treat the system. Your behavior in managing the system is the most important factor in the entire equation. You get to decide if this is going to be successful or if this is going to fail. It is on you because you are the banker. If you remember earlier in Nelson's book when he talks about the bank in Midland, Texas that went under, because the board members borrowed money but never paid it back. A real bank or a real business or a real farm operation is not going to survive if you are a lousy manager of money. Your behavior is the most important factor in anything. If you behave like it's free money, you're going to end up like my client who took his loans for 11 years, never paid them back and only paid premium and did not pay interest. His behavior was not warranted of being a banker. He is not a thief, but his behavior was very thief-like. I even get the question, well, Mary Jo, if I don't have to pay it back, why wouldn't I just put the money in there and borrow against it and never pay it back? Why wouldn't you just go to the farm and have every cow that you butcher every head of cattle that you have, you butcher it, you put it in your freezer, you don't sell it, you eat them all yourself. Never take anything to the market. How long are you going to be able to survive if you never buy your own meat from yourself? You can't. Your behavior is imperative to being a banker. If you cannot put the banker hat on, this whole infinite banking strategy is not for you. If you are super busy and saying, I am so super busy, Mary Jo, I cannot even think about handling my own loans, then you go to the bank and you let them handle your loans, and then you stop complaining about the fact that they're questioning everything that you do. You don't get to just say, I'm going to be the banker and not act like a banker. So now in this chapter, or in the end of this chapter, we've learned about paying ourselves back extra. We've learned about being honest and using our imagination, reason, and logic, and finding some money. And what are we doing with that money? Are we going to backdate a policy, or are we going to get extra in year one? Are we going to self-insure? And I don't even think the self-insuring, I think that was just an example of, hey, think outside the box. Where else is your money going in your household that you're not paying attention to, that you could take control of it and run it through a policy? And I don't think that that was a literal, hey, go self-insure, as much as, hey, what are you doing with your money? And take a look at that. And we need a system of policies. How do we start that system of policies? And when do we start that system of policies? I don't want you having 15 policies and you can't afford 15 policies. Right? He says start them as soon as possible, not start them all at once. As soon as possible is not the same as, oh, tomorrow I need to start 15 of them, or I need to start one every year. No. You got to be able to afford them. We will start them when we can afford them. When we can make loan repayments and premium payments, we can start more than one policy. So now you have what you need out of the equipment financing. It is all stuff we have talked about before. It is just really a nice reminder, right? Of, oh, what was the first part of the book? And we're going to apply it again. A lot of this seems repetitive, but we're catching it at different times in our learning process. And so it's okay. It's great because now we're learning something every single time, but we've actually heard it all before. Okay, you guys, I know that these last two podcasts were helpful. Even though I may have jumped around a little bit and added my own little stuff in between, this was a helpful chapter to me to read and just re-familiarize. I don't know if I said that right. Get acquainted with again. If you want to hear a subject, if you have questions, let me know at maryjo@withoutthebank.com. If you have not gotten the book Farming Without the Bank, please go ahead and do that at farmingwithoutthebank.com. You can get mine and Nelson's in a bundle. And I also have mine on audio there that you can download. So if you are somebody that is listening, sitting in a tractor all the time, wanting to share it with others, driving in a car, whatever, get the audio, download it, and listen to it there. It is only like a 2-hour listen because there's only 99 pages. It's not that big of a book. Once you have the book, you've read it, you've listened to it, then we can sit down, do a free 1.5-hour consultation, see what you have going on, and if this is going to work for you. If it doesn't, I will tell you. I am here to teach, not to sell. Let me know if there is anything I can do. But until then, I will catch you in the next podcast. Have a great day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.